And sure enough, a few days later, we see the first stage of a long-term turnaround in the dollar index. It typically happens this way, so don't use commitment of traders report to time the market. Use it to kind of give you an indicator of where the market may be heading, but realize that the commercials are very early. And we'll start touching upon why they're early as we continue forward. Here's another example of a chart. In the news as well, we have gold. Gold is constantly coming up. People are wondering if it's the new currency or it's the third currency, you know, the US dollar versus the euro versus gold. And it's had a tremendous run up. And we'll look at the 3 weeks that occurred prior to its pullback. December 22nd, again, we see the longs at 126,000 in the futures market for the commercials. Then we see the shorts, 306,000. So the shorts, long before there was a turnaround or a pullback, had already decided that the market was just overheated, and that the commercials just couldn't take it anymore. We then have the second week come in, and we see that the longs haven't really increased much by the commercial standard, from 126,404 to 126,677, but the shorts have increased by over 8,000 contracts. Huge jump up. And again, they're early. There still hasn't been a turnaround. So now on January 6, 2004, we see that the longs are 132,411, still an abbreviated jump up compared to the shorts, which moved to 321,113. And again, the second week literally could have been ignored in this scenario. Between the first week and then the third week, we finally get the action that we're looking for on timing, because soon after it reaches an all-new high of 430, the gold can't sustain that. It tries another brief rally up, and then it tanks down, and now it's driven down to 400, and it actually fell a little bit less than 400. So the commercials are definitely ahead of everyone else, and part of the reason is scalability issues. They can't get in the market all at once. The reason why I put this live cattle report here is because it's very interesting to see how fundamental changes in what's happening in the marketplace can actually affect what the commitment of traders report does and how things are going to operate. As you look here, you see on December 22nd, 2003, longs were up at 43,195. The shorts were at 59,505. So the shorts had already anticipated that the market was overheated. And then the mad cow scare comes in. And unexpectedly, the market begins to drop. Now, I talked to you before about limits in the marketplace. Every dash that you see that's going, that goes after the fall is actually a limit move, showing that the market dropped 150 points and there's no more activity for that day. In fact, we had 3 limit down days during that time period. Then we look at the next commitment of traders report, and we see that longs are 48,000, shorts are 63,000, and that the shorts are very, very heavy. But it's almost anomalous. You know, who wouldn't have shorted? What commercial wouldn't have shorted futures at that time when they thought the mad cow disease may even go even worse against their positions? Because you have to remember, someone owns the cattle that they have to sell into the marketplace. So they jump in to protect themselves, possibly because they weren't doing a great job before with their marketing strategy, or possibly because, in this instance, mad cow disease was a surprise. So it's almost, again, the second week is almost unimportant in this scenario, because in the third week, January 6th, we see longs 41,566. But what's really important here is we see a huge drop-off in shorts. From the first week to the third week, we see over 10,000 contracts just evaporating, almost 20,000 contracts from the second week to the third week. This shows that the shorts are exiting the market, and there's undoubtedly going to be a short covering rally. And sure enough, it just follows suit. We get, again, several flat lines where the market locked limit up, and we see a brief rally in the live cattle scenario. So the commitments of traders report, very good tool to kind of give you an idea of where the market's heading, but don't use it for timing. Now, everyone who's ever traded understands support and resistance. You know, there's 2 points where the market is going to roll in between, where it's going to reach a high and a low, and if it breaks through the support, it's going to continue lower. If it breaks through the resistance, it's going to continue higher. But what's unique about support and resistance in futures is hedgers perceive it completely different from general speculators. Hedgers see support and resistance where the buyers have a set price that they're willing to pay versus the sellers who have a minimum price that they accept in order to stay in business. These are real goods that typically are raw material that has to be manufactured. And so because of how hedgers see support and resistance, 85 to 90% of the time, commodities stay in a tight range, limited volatility. In fact, most of the time there's nothing to trade. The only way you can trade is if there's fundamental changes in how the supply and demand has occurred, such as the mad cow disease or with oil with Iraq. So as I said, even though there are 370 active futures contracts, at any given time there may only be 25, 30 contracts that are worthwhile trading because they're moving out of these ranges. I think at any given time you may see gold have a range of 2 to 5% when it comes to market movement, significantly higher than some stocks which may move 15, 20, 30%. But because of the leverage, the small percentage moves create larger gains. So there's a lot, oftentimes when people look at futures, they think there's a lot of volatility. And in fact, it's not the futures that are volatile or the goods, because otherwise you just couldn't go to the grocery store and buy your loaf of bread because you'd always worry about what price it would be. And it might be exceptionally high one day and exceptionally low the next. It's not the volatility, it's the leverage that really drives the market and makes people afraid. Now in trading support and resistance, in futures they form long channels. Sometimes these channels can be 6 months, 7 months, 8 months, in which prices really roll in between 2 points constantly. The buyers have found a sufficient price and the sellers have found a sufficient price, and in between those 2 price points are profits that speculators can come in and grab because the hedgers are satisfied. Breakouts in futures only happen when there are fundamental changes in supply and demand, whether there's a shortage or whether there's a hurricane coming in that may ruin the next crop of cotton, any number of things that change the fundamental supply and demand. Prices just don't move because they want to move. They move because they have to move. And that's a very important concept. It's a lot different from stocks in which you have earnings price reports or analysts really pumping the market. The reality is if there's not enough cotton around, the prices are going to be driven up. So the goal is to exploit opportunities that show that prices are somehow out of tune with the current reality, whether it's a new set of inflation numbers that came out, whether there are goods that have been substituted, for instance, and we'll talk about 3 different goods that substitute between each other, or just change in usage. Maybe people, one of the big industry brouhahas right now is no-carb, low-carb diets. Well, with no-carb and low-carb diets, the bread-making industry has actually experienced a 30 to 40% loss in business this past year. Well, it's going to reverberate right back to the futures market and how they hedge in the wheat market. And in fact, if they'll bother to hedge at all, and it goes back to the farmers who have to sell it, and it directly affects how the markets are operating. And this is a huge lifestyle change in America, especially when cereals have tons of grains in them, breads, and a lot of stuff that we don't even know about that has wheat and gluten in it. So change in usage has a direct impact on how you can trade futures as well, and how items break in and out of support and resistance. Now, this is an example of the euro currency March contract, and it's just to show you how major support and resistance channels affect day-to-day trading. When we look here, since June of, or late May of 2003, the euro currency moved into a whole new realm of pricing. It began to top out $1.17, and it rolled down to, in July, mid-July, down to a low price of $1.11.